Fellow traders, James Stanley with StoneX and Forex.com. Gold bulls are back in a very big way this week. And I remain bullish, as I have pretty much for most of the last 21 months. That said, being bullish and setting up long strategy are two totally different things. Risk management is the big chasm between the two. And so I wanted to use this video to show how I can use multiple time frame analysis to set a trade plan in gold, particularly when I have that bullish fundamental bias. So let's get to the chart and start chopping this up. First and foremost, I want to look at the long term to highlight why I think that fundamental bias is still in order. And really, this dials back to last year, and I think it helps to deduce the fundamental drivers behind a move to see why or how it might continue. So last year, we had just 2 days where gold closed below the 2K level. And it just so happened that that was after a US CPI print. It was in February of 2024. US CPI comes out well above expected. Markets began to show skepticism that the Fed will be able to cut rates. A day later, Chicago Fed President Austin Goolsbee, really widely followed Fed president, in a television interview says, let's not get all flipped out about one inflation report. And it wasn't one inflation report. The prior few CPI reports had also come in above expected. But markets heard that the Fed wanted to cut rates, even with inflation well above their target. And so that's why I think this has been dubbed the debasement trade. It's the Fed willingly cutting rates, even with inflation well above their 2% target. And it's not something that I think has changed or shifted. You know, maybe it's went on pause, or maybe we've had a couple of periods where markets were starting to expect that the Fed was going to calm down. And I think that's what explains these two periods here. So again, 2K was the launch point last year. Gold goes parabolic. And then we had 2 months of digestion last year. This just so happened to be right around the presidential election. And perhaps not coincidentally, this is when Bitcoin started to take off. We had that first rally up to 100K in Bitcoin right around the time that gold starts to build this bull pennant. Lasted 2 months. Coming to 2025, blast off again. This time, gold tags 3,500. 3,510 cents to be exact in April. And then it digests for 4 months. What ultimately kicked this out of that pattern was Jerome Powell's speech at Jackson Hole, where he finally sounded ready to cut rates, and gold then goes parabolic. So again, I don't think that anything in that fundamental backdrop has shifted. I'm not expecting the Fed to start looking at being hawkish. I'm not expecting to hear of any austerity. I've went over some of these quotes from President Trump, where when he says something along the lines of, when you have the type of growth that we have, you grow your way out of your debt. I don't think that we're going to be hearing about balanced budgets in the U.S. anytime soon. And I think gold is going to be a beneficiary of that. But again, this is about strategy. This is about looking at ways to use charts to try to get in that trend in a strategic manner rather than just spray and pray and hope that it's going to continue. 4 months of consolidation here, 2 months of consolidation here. So far, we've had just a few weeks of consolidation, so this is still rather light. And if we look at this, we had this close right around 42.50 and open right around 42.50. That so far has held as resistance this week. And if we look at these prior periods of consolidation, getting long on highs, not the best way to go about it. If you look, however, at these lows, these underside wicks on the weekly, those could be pretty advantageous if we're able to get in around one of those and looking for that continuation of the broader, bigger picture trend to play out. Now, for the past 2 weeks, it's the 4K level that has held those lows at bay, and that's the whole reason I'm shooting this video. That's the whole reason I'm still looking at long gold setups. Because we may have that near-term low in place. It's just too early to know yet. But if we go down tighter, there are a couple of bullish setups, a couple of bullish formations that we could work off of. So, like for instance, as we came into this week, again, 4K was the big level looking for acceptance. We had the build of an ascending triangle formation. You had this swing of support, turned resistance at 40.44. That was the horizontal resistance for the formation. We had the higher lows. That higher low, might I add, began to build off of a base of 38.95, or resistance turned support, into higher lows, ascending triangle that broke out. That's now a key point of support if we do get a deeper pullback. So again, if we draw back to that weekly chart, and let's just say, for instance, this stalling around 4250, 4300, or inside of 4380 compels a deeper round of consolidation, similar to what showed in April, well, then that automatically becomes the next spot to look to for bulls to come in to defend above that 4K level. The problem with that is if we get a pullback that deep, then something may have shifted or changed in the backdrop. But nonetheless, I'm looking at that as a key spot of support. I'm going to call that an S3 level for now. My S2 level, I'm going to look at right here. This was an intra-week level, and we had a short-term double bottom that had built here. And notice that happens right around the 4100 psychological level. These psychological levels could be really big in a market like gold, because even folks that aren't technicians will have respect for them. For instance, you can see where we had this rally and then this dip slightly inside of 4100, and it was bid. And then we get another dip inside of 4100, also bid. Now, the reason that a double bottom is such an attractive formation is because you have those two matched lows, and then you have a very clear line in the sand called the neckline. The neckline is going to be, on a double bottom, the high between the two lows. And then you get a projected move or target off of that based on the size between the bottom and the neck. That comes right in at like 41.93, and we ran right to that just shortly after that formation had filled in. Formation triggers, and it runs right up to that target and continues to run all the way until we got really close to that 42.50 level. This is within like $5-6 of that 42.50 level. But remove that. But that becomes, again, another key point of support. I'm going to call that my S2 for right now. My S1, and this is a level I've been talking about on Twitter for some time. It's right around 41.55. We had these two perfect highs, or almost perfect highs, that lined up really, really closely. We saw buyer shy away from a test there. That's ultimately what built the double bottom that we broke out from, and that's now already being tested as support. I'm going to call that S1. The challenge with S1 right now is the train's already kind of left the station, and by the time you watch this video, it's probably going to already be developed a little bit more. If we're able to strike on that candle close, that's a lot more attractive, and the reason for that is you have those two matched lows right at support from prior resistance, and the distance of that stop isn't going to be all too wide. It's going to allow for a 1-to-1, even if we just go up and retest inside of that prior high. At this point, because we already have this green candle, we've already had price leave that level right there around 41.72. I mean, by a decent amount, by about $20. It's going to be a lot more difficult to manage that risk. At this point, to get like a 1-2 on that size, we're going to need to see price push right into that 42.50 zone. And I don't feel comfortable getting that aggressive on the move right now, given how stretched we already are, and given the fact we've already seen price turn around from that 42.50. But that is S1. So if we get a pullback, like let's say we get up to like 42.20, 42.30, wherever, as long as we don't set a fresh high, but if we get a rally up there and then a pullback, what I need to see to allow S1 to remain as a support level is I need to see a hold above those lows. If we get a break of those lows, then I think that S2 is coming into play. I'm still open to taking a bid off of S2, but again, I'm going to need to see that hold around that same prior level. It's less enthusiastic if we break that higher low, because then the higher low, higher high sequence is done. But again, that's not the 4-hour chart isn't the chart that I'm trading. I'm trying to trade the daily chart, trying to trade the weekly chart. I'm just using the 4-hour to do it. So if I got to take a shifted trend, as long as I got that support hold in there, I can still work with that, because at the very least I can manage that risk and I can play for a bounce. S3 is right here, and then S4 right in there, right at that 4K handle. You'll notice that trend line projection that made up the ascending triangle, it intersects with 4K like Monday afternoon next week. So if we do get the deeper dip, if we do get, I call them Friday flushes, Where previously there was a tendency for Fridays to show really big hits or really big rallies in gold, often in a counter type of manner. But if we get a Friday flush this week, I even still take it as long as we get a hold of 4K into the weekly close and holding through next week's open. For resistance, again, I want to be cautious up here, especially if not already long, because we've already seen it play out once where we got to that 42.50 level and the buyer shied away. 42.50 is a big spot. I was going to call this all like 142.50-ish areas, 42.50, 170 to be exact as the level. 43.80 is where we saw the prior double top print. Really, I think this show is all about 4,500. I think that's the reason we saw 43.80 stall the move out. Very similar to the way that we saw this 27.90, which I know it seems like a random price last year, but 27.90 is what topped it out. Because I thought, we're getting close to 3K. It's so stretched. If you want to get a stop below the prior swing low, you got to go all the way down to like 23.80, 22.88, excuse me. You got to go deep and take on $400 or $500 of risk. It's not easy to justify a 3K stall if you're taking on $500 of risk. So thereby, it can lead to a bit of game theory, if you will. But that's what I'm looking at in gold. Still bullish. Just all about ways of getting long in a strategic manner where I don't have to outlay way too much risk and run into a brick wall of consolidation. Because we had 2 months here, 4 months here, only a couple weeks. It's still pretty early, and I am still of the belief there's a lot of long-term holders that might use these rallies to try to wiggle out of their positions or at least manage off some exposure. So that's what I'm looking at as we go into next week. But as always, thank you for your time and happy trading, ladies and gentlemen.